So welcome everyone. This is our final financial reporting update for 2018. We're expecting it to take about maybe 40 to 45 minutes today, including questions. My name is Elisa Noble, and I'll be joined by my colleague Moses Surfati a little later on. In terms of what we'll be covering, as we are now heading into the first full-year reporting season since our two major new IFRS standards, IFRS 15 on revenue and IFRS 9 on financial instruments, became effective, we'll be taking a look at the key disclosure changes brought in by these standards and also looking at what our regulator, the Financial Reporting Council, the FRC, has indicated it expects to see in annual reports. Next, as part of our other year-end reminders, we'll briefly remind you about some of the other standards and amendments that are newly effective, then go on to run through other recent publications issued by the FRC, including their annual review of corporate governance and reporting. We'll also take a look at the areas that the FRC will be focusing on during their reviews of annual reports for the next period going forward. And finally, we have just a few other items of recent financial reporting news to tell you about. Okay, so as I mentioned, IFRS 15 and 9 are introducing a large number of changes to disclosures. So this involves new disclosure requirements as well as changes to existing disclosures relating to revenue and financial instruments. In combination, this could well give rise to substantial changes to many companies' annual reports. And this is whether or not companies have actually been affected by changes in their accounting policies or put through material transition adjustments for either of these standards. Basically, this is likely to take up potentially a lot of time and effort for many companies. So we'd suggest that it's worth starting early and making sure you've also got the systems and processes in place at this time, really, to make sure you'll be able to put all of these disclosures together. And due to the significance of all these changes, the Financial Reporting Council is considering the adoption of IFRS 15 and 9 quite a significant challenge for companies, and for that reason, they're monitoring the quality of reporting in this area, and they've indicated that they'll be focusing on this for the next few years. So we'll be looking at what the FRC has said they will expect in the first year. So, three standards are mentioned on the screen. So this is just to explain to you what all these changes are about. So basically, at the very least, all companies will need to update their accounting policy disclosures to reflect the new model under IFRS 15. But in addition to that, some companies, those with more impact on transition, will need to explain the impact on adoption of the new standard on their financial statements, and many companies, or most companies, will need to take a look at the new additional disclosure requirements that IFRS 15 brings about. So three standards to think about, giving rise to changes in the annual report this year, just on revenue recognition. So in terms of accounting policies, to put this simply, what we mean here is that some companies with even perhaps quite simple revenue recognition at the moment might have an accounting policy that refers to transfer of risks and rewards. What we've got to remember is that the model has changed under IFRS 15, and so we shouldn't just be referring to risks and rewards now, but should at least be explaining that revenue is recognized based on the transfer of control. Risks and rewards is only one indicator now. Many companies might need to change their disclosures of judgments and estimates, or you could have new ones to disclose, maybe to explain why you qualify to recognize revenue over time, or how you've concluded about identifying separate performance obligations. In terms of the transitional disclosures, so if you're needing to put through actual adjustments on adoption of the new standard using either of the transitional methods, IAS 8 as well as IFRS 15 specify a number of specific disclosure requirements to be made. That means to explain the impact of transition on all the line items affected and to explain to the readers what's giving rise to that. If you are using the modified retrospective transition method, that's the one where we put through the effect of transition as a cumulative effect adjustment in the opening reserves of the current year. If you're doing that, then remember what that means is that your comparative figures will still be under old GAAP, so under IAS 18. If that's the case, IFRS 15 will require you to disclose current year figures as well on an old GAAP basis to allow readers to see some comparability. Finally, IFRS 15 introduces a whole host of additional specific disclosure requirements, and that's what we'll take a look at next. So on this slide, we've got some of the key areas of change. This is not absolutely everything, but some of the key points to just highlight. So firstly, companies will need to create a new note where they analyze their revenue based on categories that are relevant in explaining the nature, amount, timing, and uncertainty of their revenue recognition and cash flows. We've got some examples about that on the next slide, so let me just come back to that in a moment. But it's worth noting that for many companies, this will typically be an analysis using several categories and not just one. And this may or may not be similar to any segmental information you're disclosing if you're currently a listed company. In terms of contract balances, that's referring to things like accrued income, unbilled revenue, or deferred income. Under the new requirements, you'll need to provide a note that sets out movements in these contract balances, so brought forward, carried forward, what changes have happened in the year, for example, as a reconciliation note. In terms of performance obligations, separate performance obligations under IFRS 15 are now the new unit of account for revenue recognition. So first of all, that can be a tricky thing to figure out how to identify separate performance obligations. But once you've done so, you'll need to disclose in the accounts what the nature of the goods and services is in respect of the performance obligations identified, when they are satisfied, significant payment terms, any obligations for returns, refunds, and potentially warranties. So this is quite a lot of additional information that older revenue recognition accounting policies typically may not have included. IFRS 15 also includes a few specific judgments to be disclosed. So this is going beyond the general requirements to disclose judgments and estimates under IAS 1. So some of the ones that are specified are in relation to the determination of the transaction price. So that might involve judgments about variable consideration, for example, and how that's allocated to each of the separate performance obligations identified. Finally, the last point there is to do with costs of obtaining or fulfilling a contract. So this is an area where there is new guidance under the standard, and in addition to that guidance about when you can and cannot capitalize any of these costs as opposed to expensing them, any amounts that are capitalized will need to be explained in terms of what the balance is, how they're being amortized, and any impairment recorded. So here then we have some of the suggestions from the standard of types of categories that you might consider when thinking about how to disaggregate revenue for the purposes of the disclosures. So for example, it could be based on the types of goods or services, some of your major product lines, maybe by types of markets or types of customers, sales channels, things like that. You wouldn't typically be providing all of those categories, but the regulators are currently expecting perhaps more than one category. In the box on the side there are some questions that the FRC has suggested companies should be thinking about, which includes making sure that the categories are relevant and meaningful for your business in particular. So different companies will choose different categories. Also to make sure that this information is consistent with other reporting about revenue that you may have, maybe in your narrative reporting, the front end of the annual report, or in other communications such as investor presentations, so that you're giving a consistent story about your revenue recognition. So the Financial Reporting Council has very much been focusing on the implementation of IFRS 15 and 9 by companies because they consider this to be quite a big challenge for many companies. So one of the things they've done is conducted a thematic review on both of them during the past year. And how they did this was by looking at June 2018 interim reports of some listed companies in industries that are potentially more significantly affected. And they did this with a view to be able to provide some guidance now at this time of year to highlight areas where they think companies should be improving by providing more comprehensive disclosure, but also to share examples of best practice. So these reports, we think they're well worth a read. They include a lot of good examples of how you could go about putting through these changes to disclosures in your annual report. So for IFRS 15, on this slide, we have some of the findings that the FRC noted from their thematic review. So they were pleased to note some good examples of explanations about the impact of adoption, and also they noted that some companies were providing the analysis notes disaggregating revenue into several useful categories. So that was good. But then in the red box, of course, they noted some areas where companies could improve on. And I think the overall message here is that the FRC really wants companies to focus on providing very entity-specific and comprehensive disclosures in this initial year to explain the effects of the transition, and also now and going forward to describe their new revenue recognition accounting policies in a much more detailed and entity-specific manner that has been potentially the custom under the old standards. So, for example, in terms of transition, they saw that some companies were just setting out their new accounting policy, but without explaining how that was different from the previous one. Some companies didn't explain which transition method they were using, and they didn't necessarily explain what the transition adjustment made actually comprised. Other areas that there wasn't much disclosure about was the impact on the balance sheet, accounting for costs, and some of the significant judgments made, despite the specific requirements in the standard to do so. And also they found that the descriptions about performance obligations were really quite generic. Another thing they pointed out, not necessarily so relevant to the interim reports, but especially more relevant for annual reports, is for companies using the modified retrospective method, where your comparatives have not been restated, is to think about when preparing the narrative reporting for the front end of the annual report about how you can highlight to the readers that there may be a lack of comparability. So to highlight that, or possibly to consider whether you should be providing your figures in the front end on a both old GAAP and new GAAP basis, or something like that, to avoid a lack of comparability. Okay, so those were the key findings. In terms of the main recommendations going forward, the key areas to focus on for the coming annual reports, those are summarized on this slide. So the first 2 points, focusing on making the disclosures about the impact of transition as comprehensive and entity-specific as possible, and linking it to other information. So that would, for example, include providing a clear breakdown of any transition adjustments made into categories of impact and explanations about those changes, and to then make sure that the new revenue recognition policies are explained in detail. So performance obligations is an area that was a significant change under IFRS 15, and it is very judgmental. So each company needs to apply their judgment to determine which promised goods and services they consider distinct and therefore should be accounted for as separate performance obligations. Since that is so entity-specific and judgmental, a quite substantial level of disclosure is expected in the accounting policies about this. And a reminder to not forget about the balance sheet impact, so that means how contract assets and liabilities are recognized and when, and to explain that also in the accounting policies, something we haven't really necessarily seen before so much. Okay, moving on to IFRS 9. So similarly here we have basic requirements for accounting policies, judgments and estimates under IAS 1 that will need to be updated. So most companies do have some financial instruments. It will depend on your business, how complex they are, how many different types you have, but I'd say most companies have some trade receivables or some intercompany balances, things like that. So you will be affected by IFRS 9, and you'll need to update your accounting policies to explain how the new classification model has been applied. Make sure you're not referring to things like available for sale anymore, which doesn't exist. Instead, using the new categories and explaining how the new classification model has been applied, and also how the new, especially important, how the new impairment approach has been applied. That's the one that's all about recognizing expected credit losses, ECL, as opposed to incurred credit losses under IAS 39. So make sure to update all of those parts of the accounting policies, judgments, and estimates. Then, to the extent that you have had to put through any significant transition adjustments on adoption of IFRS 9, that will need to be explained. There are specific requirements. You'll potentially need to reconcile the impact on a line-by-line basis. And finally, as for IFRS 15, there are also a number of specific new disclosure requirements. In the case of financial instruments, these disclosures are included in IFRS 7, so that's the same as before. They weren't in IAS 39, and they're not now in IFRS 9. They are still in IFRS 7, but IFRS 7 has been significantly changed, and some of the disclosure requirements have been expanded. So in terms of, on this slide, we've got the three main areas of IFRS 9 impact: classification and measurement impact, impairment, and hedge accounting. And each of these areas has new and changed disclosure requirements. Probably the most significant is impairment, so we'll come back to that at the end. But firstly, just in terms of classification and measurement, remember just some really basic things, like we tend to have some notes in the financial statements where we break down the classes of different assets and liabilities and set out their carrying values and their fair values. All of these notes need to be updated to reflect the correct terminology. Make sure you don't leave any of the old IAS 39 terminology there. But apart from that sort of updating, there are also some specific disclosure requirements on some of the new areas under IFRS 9. So one of those is, for example, the new fair value through other comprehensive income classification category, which in the case of equities, so for example, some of the unquoted equity investments that you might have previously classified as available for sale, those might now be either fair value through profit or loss or fair value through OCI. And if they are in this new fair value through other comprehensive income category, then there are some very specific new disclosure requirements to comply with. Hedge accounting, of course, companies have had the choice to decide whether they were going to continue to hedge account for existing hedges under the old IAS 39 approach, or whether they were going to move to the new model under IFRS 9. Now, very important to note that regardless of which choice you've made, so even if you've decided to continue hedge accounting under IAS 39, which you are quite validly entitled to do, you must adopt the new hedge accounting disclosure requirements, which are now included in IFRS 7. Some of the changes include a more detailed explanation about your risk management strategy and breaking down some of the disclosures by risk category. That means, for example, breaking things down by whether they are hedges of interest rate risk, foreign currency risk, as opposed to just the type of hedge, which we were required to analyze in the past, so fair value hedge, cash flow hedge. Okay. Now, on to impairments. Here, really what this is all about is in expanding on the credit risk disclosures in IFRS 7 to explain the basis for the expected credit loss calculations and how companies are measuring their expected credit losses, and also how they're assessing changes in credit risk. Some of the key things to think about are on this slide here. So how are you going to explain in your accounts how forward-looking information, one of the new requirements in the ECL model, has been incorporated? What inputs, assumptions, estimation techniques have been used? How in practice have you come up with the numbers for the expected credit loss provisions? If you do have any balances under the general approach, for example, any loans with related companies, you will need to be assessing for any significant increases in credit risk. And if that is the case, then you will need to explain how that is being done. How is default being defined, and how are you grouping financial assets together? Some of the other matters that need to be disclosed. Okay, finally, what did the FRC say in their thematic review about IFRS 9 then? They were pleased to note some good examples of disclosures about the impact of adoption. So some of the heavily affected companies were providing good quality balance sheet reconciliation notes. And also some companies where the impact was not so material were providing good quality qualitative descriptions about the impact of adoption. So that's something the FRC expects for both IFRS 15 and 9, explain why the impact is not material, especially if it otherwise might seem like there could potentially be some relevant impact. In terms of areas that need to be improved, where comprehensive disclosures are expected, as for IFRS 15, the accounting policies should be entity-specific, especially in relation to the impairment approach, not boilerplate or generic. Make sure there's no old terminology still included there. Any transition adjustments need to be explained in terms of how those link to the nature of the changes in accounting policies and how that is different from the previous approach. Make sure that there's an explanation of some of these things, like how forward-looking information and other assumptions have been included. And to the extent the company is designating assets into some of those classification categories, what really is driving those designations? Make sure that's explained. In terms of the year-end recommendations, for IFRS 9, which was slightly different from IFRS 15, there was a longer list of recommendations actually from the FRC. So they did remind companies to make sure the quality of those transition disclosures was good, but also they wanted to remind people about the scope of the standard with just a few reminders there. For example, remembering the potential broadness of the scope of the impairment requirements. Have you remembered about contract assets and financial guarantee contracts? Those also come under the expected credit loss model. Remember the changes to the requirements about debt modifications, and that we don't bifurcate embedded derivatives for financial assets anymore, and the various changes to hedge accounting. Okay. So that brings us to an end of the reminders about the IFRS 15 and 9 disclosures in this year's annual reports. We'll now move on to some of our other year-end reminders.
Thank you, Lisa, for that extensive look at the new disclosures required under IFRS 15 and 9. I think that the time taken to prepare these new notes should not be underestimated. However, these aren't the only new standards that are effective in the current year. There are some others that aren't as wide-ranging, and we're going to take a look at those, and as well as other standards that will come in over the next few years. So on this slide, you can see the ones that are coming in the current year. We've talked about IFRS 15 and IFRS 9. There's a few others listed there. And looking forward to next year, we've got IFRS 16 coming in, which again is expected to be quite wide-ranging, and IFRIC 23, uncertainty of income tax treatments, which again could be wide-ranging in some sectors. And there's a few others coming in for 2019 and beyond. In terms of the other big one coming up, I suppose that would be IFRS 17 insurance contracts, which will have a big impact on the insurance industry. There's a proposal at the moment to defer that effective date to 2022. So we'll see where that goes. In terms of EU endorsement, just a reminder that UK companies are only allowed to adopt IFRS standards when they have been endorsed for use by the EU. All the ones up until IFRIC 23 have been endorsed for use by the EU. The ones after that, so annual improvements 2015-2017 cycle onwards, those have not yet been endorsed. So we'll now look at some of the standards coming in for 2018. So IFRIC 22 is a clarification that basically clarifies the uncertainty that used to exist as to where you received consideration in advance of delivering goods or services, you treated that as a monetary item and retranslated it, or you treated it as a non-monetary item. There was some diversity in practice. This IFRIC was issued to clarify or remove the diversity, and it's quite clear that you translate the consideration received on the date it is paid, and it is not retranslated subsequent to that. In terms of adoption, there are three alternatives for adoption of this standard. You can go fully retrospective, or you could go, you could adopt it for transactions recognized in the period of adoption, so assuming you are a December 2018 year-end preparer for transactions from 1st of January 2018 onwards. Alternatively, you can choose to adopt it at the beginning of the earliest comparative period. So following on from the example of a 2018 year-end preparer, you could choose to adopt it for transactions from 1st of January 2017 onwards. So there's a few other amendments that we've summarized on this slide. I'm not going to touch on all of them. The first one I'm going to touch on is on the amendment to IAS 28. This touches on the exemption available in IAS 28 to fair value interests in associates and joint ventures. So you normally equity account for those, but you now have a choice. There's a choice for venture capital organizations or entities that consider themselves to be similar to venture capital organizations to fair value those. The clarification states that this is an election made on an investment-by-investment basis, so it's not an accounting policy choice. It's a choice on an investment-by-investment basis, and that choice is made on initial recognition only. The next amendment I want to touch on is the amendment to IAS 40, investment property. Again, this is a clarification that was brought out due to some diversity in practice as to when you would transfer an item of property into or out of investment property. The clarification states that intention alone is not sufficient. There needs to be an action or a change in use to accompany the change in designation. So, for example, if you had an investment property that you decide to occupy for your own use, just the intention to change the intention to change the occupation is not sufficient. You would have to actually started owner occupation before you transfer it to property, plant, and equipment. The next one is on IFRS 2 share-based payments. Again, there are three changes here. A couple of them are perhaps not wide-ranging, but they just perhaps confirmed what people were doing. So the first one was cash-settled share-based payments you treat vesting and vesting conditions in the same way as you would for equity-settled share-based payments. The second one, where you have a net settlement feature, for example, where the employer is required to withhold an amount for employees' tax obligations in relation to share-based payments, that net settlement feature would not on its own preclude classification of the share-based payment as equity-settled. And clearly the difference between equity-settled and cash-settled is that equity-settled you fair value once, cash-settled you have to fair value at each reporting period. The third one perhaps is a bit more wide-ranging, where you've got a modification of an a cash-settled share-based payment to equity-settled. Again, the clarification there just sets out the accounting that you would fair value the equity-settled share-based payments, and any difference between that and the carrying amount of the cash-settled liability would be recognized in profit and loss, and then you account for the arrangement as a normal equity-settled payment after that. So now we're going to be looking ahead to next year. IFRS 16 is going to be coming in. In terms of a concept, it's not a big change. We're used to seeing leases on balance sheet. It's just that now most leases will come onto your balance sheet. And again, looking at what the FRC is saying on this, they're expecting companies to give specific, meaningful disclosure about their circumstances and not just describe what effect IFRS 16 is going to have generally. And what they mean by that, they say, well, you ought to be able to quantify the expected impact of recognizing these leases on your balance sheet. If you're going to be applying any judgment or your policy is going to change in any way, you should again give an outline of what that's going to look like. And if you've made a decision as to which way you're going to go on transition, because the standard allows either full retrospective or a modified retrospective approach, then tell the users of the accounts what you're planning on doing. In terms of what we're seeing on this last point, we are seeing a lot of companies going to modified retrospective, where you just bring on the leases on, assuming a December 2019 year end, on 1st of January 2019 onto your balance sheet. You don't restate comparatives. So again, there's decisions to be made and disclosures to be made in the accounts about this. There's also a specific disclosure requirement on adoption of IFRS 16, which requires a reconciliation of the operating lease commitment note as disclosed under IAS 17 to the leases recognized on balance sheet under IFRS 16 at the date of adoption. So clearly we are just recommending that people take perhaps extra care when preparing this note in the current year, as it will form the basis of a reconciliation and a disclosure next year. And just staying on IFRS 16 for a bit, in terms of implementation challenges we're seeing, so for lessees, clearly, like I said before, all or most leases will come on balance sheet. And in terms of differences to existing practice, say under IAS 17 for finance leases, IFRS 16 has specific rules on in-substance or variable lease payments that are in substance fixed, where you would end up amending the carrying amount of your liability as opposed to expensing any variable lease payments through P&L, which is what you might have done under IAS 17. In addition, IFRS 16 requires the payments to be discounted, and that's normally at the rate embedded in the lease or your incremental borrowing rate if the rate in the lease is not available. Most companies are having to determine an incremental borrowing rate, and that's bringing some challenges. There's also tax issues on transition to consider. For lessors, again, not much of a change, but there are some minor tweaks that, again, probably just need to be looked at. If you're subleasing, you need to consider whether your sublease results in you having a finance lease. Where you modify leases, again, this wasn't covered in IAS 17. There's specific rules there, so again, look at those. And again, also sale and lease backs. The expectation is that the profit recognized on a sale and lease back under IFRS 16 is going to be less than what you would have done under IAS 17. So again, if you have done any sale and lease back, you probably want to look at those again. moving on to regulator focus and what they're going to be looking at for 2019. We'll just cover the recent FRC publication. So at this time of year, the FRC put out their State of the Nation reports. Their key one is the annual review of corporate governance and reporting. They also write, or will have written by now, to audit committee chairs and finance directors. We've touched upon the thematic review findings from IFRS 9 and 15 before, but they've also did a thematic review on smaller listed and name quoted companies, and they've also put out what their focuses are for next year. So moving on to their annual review, again, the FRC has been making a push in the last few years, and it's making the same push on quality and transparency of financial and governance reporting, and particularly they are linking it to the uncertainty that Brexit brings in terms of people or companies should be upfront about the impact that Brexit could have on the financial statements and on any judgments that have been made in the preparation of the financial statements. So the annual review talks about the monitoring work they do, and this is where they review accounts of mainly listed companies. They did do some pre-notification last year, and they noted some improvements. And like I said, we've spoken about the other thematics. So in terms of the monitoring work, where the FRC pre-notified companies that their accounts were going to be reviewed, they noted that they felt the disclosures were better after the pre-notification. They're still saying that significant accounting policies, judgments, and estimates could be better. They also noted, and this was particularly prominent in the small company thematic review, basic errors, for example, in cash flow statements. They're also, like I mentioned before, they're focusing on Brexit, about being specific, talking about the impact of that Brexit could have on cash flow projections and post-balance sheet event disclosures. And supplier arrangements, again, they're still under focus. The FRC feels that perhaps this is an area that is perhaps under-disclosed. In terms of focus areas for 2019, I mentioned Brexit already. So, the impact that this could have on supplier arrangements or customer arrangements, the impact that this could have on impairment reviews and judgments that were made on those is going to be a key area that they will follow up on. They've also said they're going to look at the IFRS 15 and 9 implementation, so that's something that is quite key that you get your disclosures right on. They'll also be looking at impairments. Again, uncertainty brings about the possibility that you might end up with an impairment, whereas otherwise you might have not. The FRC have said they'd be looking at sectors under pressure, like retail and construction. And again, what they're looking at there is that assumptions are disclosed, sensitivities are given. Where you use the growth rate, again, you can justify it, perhaps by reference to some market data. And one final area on impairments that they're focusing on, again, is where companies' market value is lower than the net asset value that they're showing on the parent company balance sheet. So again, areas to look out for and consider when you prepare your accounts. And they'll also be doing a similar thematic to what they did this year for IFRS 15 and IFRS 9, but they'll be looking at IFRS 16, and that will probably won't come out till late next year when they've had a chance to look at interim accounts. In terms of other pronouncements or recent pronouncements by the IASB, we've got an amendment to IFRS 3 coming up with an effective date of January 2020. The key thing here is the definition of what a business is. There's been a change in focus, and we've underlined there what the main change is. It talks about the purpose of providing goods or services to customers, so that's the definition of an output, as opposed to returns on investments, which was the previous definition. This is expected to perhaps impact on, say, the real estate sector or natural resources sector, where it's not always clear whether you've got a business. So again, that's something to keep an eye out for in the next few years. As I mentioned earlier, this isn't early adopted, so this isn't endorsed yet by the EU, so cannot be early adopted. The ISB has also issued an amendment to IS1 and IS8 about the definition of material. And again, this is just hopefully meant to be a helpful guide so that people can decide whether or not to omit or include something in a disclosure in the financial statements. Again, it's just a change that is coming but hasn't been endorsed for EU use yet. This final slide, again, this isn't a pronouncement by the ISB, but it refers to a recent judgment in a court case where, which affects defined benefit schemes, and the effect of this is that all schemes must equalize guaranteed minimum pensions between males and females. In terms of the expected impact of this judgment is that there will be an increase in scheme liabilities, which, again, if you've got a defined benefit scheme, will mean that you actually is going to have to update the calculation of scheme liabilities. In terms of accounting issues that this is throwing up, the question is whether this reassessment of pension obligation is going to be treated as a plan amendment and therefore will hit past service cost in the profit and loss account, or is treated as a change of assumptions with remeasurement through OCI. A secondary question, if you're preparing your accounts now but your year end was before the date of this judgment, is whether this is an adjusting or non-adjusting post-balance sheet event. In terms of how one decides on this, it's going to be based on the facts and circumstances of each company, but it's something that is worth talking to your actuaries about now and to your auditors. That brings us to the end of today's webinar.